everybody. Exciting. We are going to be talking about special purpose vehicles and how they can help you as an investor. And they can help in so many different ways. In fact, I've been an investor for quite some time, and I've used them on numerous occasions to invest in things like SpaceX even. So they are used throughout the industry to do primary investments, to do follow-on investments, and everything in between. And we have one of the world-leading experts here today to talk with you about them. Jeremy, the CEO of Assure. Assure powers many of the it's a platform that allows you to create SPVs without having to hire a lawyer and everything else you need to do. So it's SPVs in a box, maybe you could say. And for those of you who heard of AngelList and their syndicates and their various SPV products, it was Assure that really launched those things with AngelList back in the day. And Jeremy's going to talk to you a little bit about that. Now, if you have questions for Jeremy or about SPVs and how to use them, you can pop them in. There's a Q&A button at the bottom of your screen, and I will make sure at the end of Jeremy's talk to bring them up and ask him in person and get everything that you've wonder about, need to know, care to understand, answered as best we can today in this exciting topic relevant to most investors. So it looks like we have a good turnout. Jeremy, would you like to take the stage and introduce yourself and start the presentation?
Yeah. Thank you for having me. I'll share my screen. I have a presentation to walk through for few minutes, and then we can get to the Q&A.
Thanks. Perfect. I'll let you know when your screen comes up. There we go. I'll drop off.
Okay. I'm ready. Here we go. All right. We're going to be talking about building a track record, specifically with SPVs. Like Hideo said, there's multiple uses, multiple reasons that people use them. Let's talk about how to build a track record using SPVs. Quick background, did talk about how we were called by AngelList in the early days to figure out how to do this stuff. But stepping back quickly, law degree, MBA, California licensed attorney. And then my big thing into this space was Utah Fund of Funds. It was a state of Utah program, $300 million. We evaluated and invested into venture funds, private equity funds. And over the 7 years there, invested in 28 different funds. Left there, started Assure, launched Assure Fund of Funds, was not successful with that venture and a handful of other things, as many of us all have our pluses and minuses on our resume. After that, the SBA called and asked for some assistance with a venture capital program where we then provided due diligence for venture funds that applied for funding. From there, AngelList called, and then the calls have continued to roll in. We have over 1,200 clients, over 6,200 SPVs, and we're basically SPV ninjas here at Assure. So let's talk about building a track record through deal-by-deal investing. So SPVs or the phrase or the term deal by deal, syndicate, SPV, SPE, there's all these different terms that people are using for them. Ultimately, you're basically doing a deal rather than a large long-term fund with lots of deals in it. And so we oftentimes will do podcasts and webinars. And so I thought I'd do a couple quotes from experts, some of Assure's clients and others, that we talk about these exact topics that we're talking to each of you right now. So Ed Roman, Hack VC, we did a panel on SPVs versus VC funds. And he talked about how he himself really thought through, do I want to join a venture fund or do I want to build my own venture fund? And he really thought the SPV was the perfect structure for him to build that track record, that credibility, so he could go either path, whichever one he chose. So he did over 100 SPVs. Then he started to raise some small funds. He eventually then raised Hack VC, a venture fund, and he continues to use SPVs around that. But he used SPVs to build his track record that then ultimately got him a venture fund because that was a path he wanted to take. Also talked with Winter Mead, who we were talking also about co-investing in SPVs. And he talked about how LPs wanting, building a strong relationship with LPs, that how do I build this relationship so they'll continue to invest with me, be it future SPVs or with, a venture fund in the future. So building a track record over time, trusting judgment, and then ultimately when you make that phone call for another SPV or for that venture fund, there's a lot of confidence and experience and history together. And so these individuals talked all about how SPVs really help that track record when moving forward in their investing career. Specifically, let's talk about these bullet points when building a track record with deal-by-deal investing. So raising money for a deal, via an SPV is far easier than fundraising for a fund. I like to use the analogy of an SPV is like dating and fundraising for a venture fund is like marriage. An SPV is something where you're saying, hey, look, I found a particular deal. So Deo talked about SpaceX. So let's use that as an example. Let's say you get access to some allocation into SpaceX. When you go out to your network of individuals, accredited investors, family offices, all that stuff, you're basically saying, hey, do you want allocation to SpaceX? That's it. This is a yes, no, up, down. What do you want? Do you want a piece of this deal? Conversation. So when you're raising for an SPV, you're raising for that deal, for that particular opportunity, giving those people or individuals or groups the opportunity to say, do I want SpaceX? They can go off and do their own due diligence. They can do their own thought process. They can talk to other people. But when you are raising a fund, it's all about you and your team. And obviously that's appropriate and great, but it's much different due diligence. It's a very different conversation. It's, can you get into SpaceX, right? Like if you say, hey, this is a space tech fund. Well, what can you get into? Can you find the next SpaceX? Can you do this appropriately, right? And they have to really due diligence you rather than the deal. And so if you're doing these deal by deals, they start to get exposure to you, to your thesis, to your ability to get into deals, the trust factor. And then when you finally call and say, hey, I want to do a venture fund, they'll be like, oh yeah, for sure. Absolutely. Would love to go in. And so when you want to build a track record, you kind of step back a few years. I like to always kind of talk about history, if you will. 10, 15 years ago, before Assure created the really affordable Assure SPV, an SPV costs the same as a venture fund. And so it really made no sense to do SPVs. They were expensive, slow moving, and used pretty infrequently. Today, SPVs are super affordable, very easy, very quick, very transparent, that you can stand up an SPV. You can basically be doing deals, by tomorrow afternoon, where years past, for you to stand up an SPV or a venture fund would take you 3 to 6 months and hundreds of thousands of dollars. And so today you can build this track record, overnight, if you will. You could do as many deals in 6 months that the VCs may do in a 10-year venture fund, because SPVs are so flexible, affordable, and easy to use today. So let's continue on this deal by deal benefits. So, you can match the deal to an LP's preference, right? And so when you go out to fundraise for anything, LPs who really run this business, right? Like if we want to invest in deals into SpaceX or anything else, LPs or credit investors need to be interested. Otherwise, that three-legged stool only has two legs, which is you as the organizer, the deal, and then that third leg is those LPs, those investors. And so you can go find deals, but you need to turn around and find LPs, and SPVs continue to be a great way to go and find them, to introduce things. It's non-threatening. It's an easy conversation. Like, hey, what kind of deals do you like? I have access to SpaceX. Like, oh yeah, I don't like space tech, or I don't like late stage. Oh, that's great. Now I know that, and now I can come back with other potential deals that resonate with you. Or you just say, I'm always going to do space tech. I'm always going to do late stage. So check them off the list, is not interested in the deal flow that I'm finding and bringing to the marketplace. And so another great way to continue to build your track record, your network, your database. Deployment pressure. So when you raise a fund, which many times is appropriate and awesome, but there becomes deployment pressure where I need to get this invested a certain amount of time, a certain amount of money. When doing SPVs, you don't have that pressure. And when you find the deal, you reach out. Anybody interested? Maybe nobody is, but maybe lots of people are. And so you can raise the right amount of money for the allocation into this deal, and you don't have to have this pressure of, I have to do this and I have to follow that. It really just gives you a lot of flexibility with regards to raising the money, putting it into the deal. And you can kind of match those two correctly or precisely. Next, lower investment minimums attract different LPs. So when you go out to raise a venture fund, the pool of investors is particular. One, they like venture funds. Two, they can write large checks. So just like a startup company CEO does not necessarily want $5,000 checks. $5,000 checks is too large of a number, but let's say 100 $5,000 checks. They would like, just like a startup company wants to really limit how many LPs are on the cap table. You as a venture fund manager would want to have as few LPs as possible. One, to manage. Two, you also have a limit. There's only a certain number of seats that you can fill with LPs. And so, that pool is particular and small. And so when you go out with an SPV, though, the investors are different. Now there's crossover between the two, but you can touch a larger group of LPs because you can take $1,000 check because this is one deal, one raise going into this one company. It's not a venture fund that needs to hit 50 million, 100 million, 250 million in size. So you can just take smaller checks. And then this allows for more people to be interested. So, Rob Coons here talked about how LPs stepping into the investment world can write smaller checks, see how it goes, come back around, try again. This stair-step ability to becoming potentially full-fledged LPs in a fund. So if your goal is to ultimately raise a fund, you could be grooming a number of your future LPs by giving them deal-by-deal access, deal-by-deal, so they can try it out, both on them committing their capital, but also trying you out with regards to your thesis, experience, and management. Finally, deal-by-deal carry is also, if not possibly, one of the best benefits of SPVs. When you do an SPV, it's self-contained. When that deal is successful, then you get carry on that deal. And if you look at a venture fund, it's typically fund carry. So let's say you have 10 deals and one is amazing, other 9 are less amazing. You may get zero carry because your overall fund didn't perform sufficiently. But if you did those 10 deals in SPVs, you then would get carry on each and every deal. So you'd get carry on that first one that was amazing. You'd get zero carry, or maybe there's a little bit of carry on those other 9. All right, selling points to your LPs. And we kind of talked about this, but Nirav mentioned that you can get access to higher risk investments, but not necessarily be part of the fund structure, this 10-year horizon with more attractive fees. So basically what Nirav is saying is that an LP can get access to these very attractive deals, but not be signing up for this 10-year venture fund structure. And these SPVs tend to have lower fees. So LPs find these SPVs very attractive. Obviously, good deal flow is very important. But I mean, that's on you, right? That's that 3-legged stool. You as an organizer, the deal that you're bringing, LPs. So if you do your part, you bring good deals. You're professional in bringing forward these opportunities using a group like Assure or others. Then that LP can say, yeah, this is very interesting. Some LPs love the fund structure and is great. Some like to do both. What we're seeing in the marketplace is there's a hybrid structure where people are interested in doing a fund, but they're also interested in doing SPVs as well. And so these SPVs are providing a fee structure which is very attractive. These are opportunities that allow the LP to kind of do their own due diligence, right? Make their own decisions, build their own portfolio. And LPs are very appreciative of this opportunity that you as an organizer that have access to these deals can bring them to them and give them opportunity to invest. And there's this win-win scenario that then builds out that strong relationship where going forward, they bring money, you bring deals, and it really starts to work well. I've seen a number of clients have extremely strong relationships with their LPs, very deep trust, and they just really bond with regards to those two desires, LPs to get into good deals through deal by deal, you as organizers wanting to bring forward great deals to the marketplace. And we see frequently clients who do SPVs and then roll into a fund in the future. But we also see that SPVs are not going away. There's kind of like, hey, we're going to do a fund now. The LPs are saying, great, I want in. But then there's kind of that quick second question, which is, are you also doing SPVs alongside? So they continue to like the SPV. So there's this kind of symbiotic relationship between the two. On deal by deal, let's talk about those fees. Management fees typically range from 0 to 2%. And that tends to be, money that would go to the organizer. And formation costs like Assure's fees are borne by the SPV. Very similar to a fund. It's how a venture fund would function, where the fund would pay for groups like Assure, and then you would get a management fee. So very, very similar. But we do see frequently a 0 management fee, but we see it, you swing. A 2% is very, very common as well. And then you just have that SPV pay for Assure's fee rather than coming out of the management fee. Next is carried interest, ranges from 10 to 20%. We see 20 all the time. Many times you'll see little side letters from GPs giving it to LPs, meaning an LP is going to bring a big check. An LP is very important to you. Maybe waive some of the carry or all the carry. It really depends on how you're building your network. But these are interesting, fun, and great benefits of deal by deal, where you can say, okay, I'm going to do this deal. I'm courting this big LP. It's coming in a single deal, and I'm going to give them a waiver, right? Maybe no management fee, maybe less carry. And so there's all this flexibility that you can do with these SPVs to work with your network, build the confidence that you are looking to build. So things to consider for SPV deals. So obviously you're looking to build your reputation, build your network, have a win-win for everyone, investors, you, the startups. And so what you're really trying to do is you're selling value. You're finding these great deals and you're adding value to these founders. Like, founders want great investors. They obviously want money, and they don't want you to send to them your 30, 40, 100 individual network, and then the founder has to deal with it. They would prefer that you do an SPV, pool everybody together, and then bring them a large check, $100,000 check, $250,000 check, $1 million check. And we have clients that are raising $2, $5, $10, $50 million through SPVs to go into these deals, like the SpaceX. They did an allocation about a year ago, and large SPVs raising millions and millions of dollars to invest into SpaceX at that time. So SPVs are the full gamut of sophistication and size, and your founders love it when you use an SPV rather than just send them a bunch of introductions. Expectations on filling allocations and timing. SPVs many times are thought of to say, there's uncertainty there. That's not what we have found. We found that our clients pretty much know how much they're going to be able to raise, and it's not typically spot on. A venture fund can say, how much allocation? You say $250,000. Like, yep, I've got that, right? Write the check. SPVs can be a little bit more fluid, where you could say, I landed at 220 or 200, but many times it's oversubscribed, right? It's 300,000, 400,000. You're going back to the founder saying, I have so much interest for your startup. Would you like me to bring in more money? And so it's actually a very positive thing when you're going to the founder. They want to feel that, right? Like, oh, everyone loves your company. I have so much interest. And they may say, no, I'm not going to give you any more allocation, but it's a great experience. And that founder feels a kinship to you as you really bring a lot of positive energy to them and their team. Getting into great deals, the speed and flexibility of SPVs is there. You like I said before, you swing back 10 years, it wasn't there. The speed and flexibility wasn't there. Today, using Assure, you can stand up an SPV in a few days. You've got your bank account open. It's really how fast your network really moves in signing docs and wiring in money. But we see clients beat VCs all the time in speed with regards to standing up an SPV, bringing in the money, and sending it on to the portfolio company. So speed is not a problem, but you should be aware of it, that you want to try to get to the point where your network's efficient, your deals are efficient. The average turnaround time at Assure for the hundreds of SPVs we do per month is about 20 days. So it's not 60 days, it's not 90 days, it's not 6 months, it's less than 30 days. And so there is definitely speed and flexibility there. And finally, finding those individuals that like SPVs. What we're seeing in the marketplace is that SPVs are becoming extremely popular, and it's not saying that funds aren't. There's still a lot of interest into funds, and funds are there. But there's this hybrid going on where people that go into funds like SPVs and vice versa. And so it's not this either or, it's this yin and yang scenario right now with SPVs and funds. And so, but some like them more, some like them less. And so it's easy for you to kind of reach out quickly. Hey, I've got this deal through an SPV. That's really a quick yes or no. The final thing I want to mention is size, which is regards to, how small or how big. So there's no real limit on the size of an SPV, like $100 million, $200 million, whatever that is for a transaction. A lot of people say, well, the size, small, how small can I go? And Assure's worked really hard to provide some products and services out in the marketplace that allow individuals to go pretty small. And so we have an Assure's Labs product that allows individuals to go pretty much, $30K, $50K, and the price still be affordable. And so I wouldn't be too concerned about saying, well, my network's really small. I can't raise $250,000 yet. Well, you can start with $50K. And so it's really about just getting started and growing that track record. So the more deals that you do, the more investors you have exposure to, the more data points, right? So when you reach out and say, hey, would you like to do this deal? And they say, well, how many deals have you done? And if the answer is 0, that's okay. But what's better is 1 or 2 or 5 or 10. As I mentioned, Ed Rome and Hack VC, he said he did 100 SPVs before he really converted over to full-time venture fund. And so 30,000, 50,000, 70,000, 100,000, 200,000, right? You can do these small SPVs and start to build that track record, get the experience, have the conversations, and then have that track record to talk to individuals and people about, this is what I've done, here's the deals I've gotten into in the past. And that just makes that conversation even more smooth with regards to that 3-legged stool. So that's the presentation, and I'm looking forward to answering questions.
Great. That was amazing. Thank you so much. I have a whole bunch of questions for you. And what I want to do is, because I know working with a number of fund managers and the like, what they want to know. So there's a question in the audience, and as you have questions, please hit the Q&A button, pop them in, and we'll get them answered. And the question is, will the deck be available? The answer is yes. We're going to make the deck, and we're going to cut segments of the video up and share it out on social and share it out on founderinstitute.com. So you had mentioned, so let's start jumping into the questions, okay? So you had mentioned that you have Assure Labs and you can do SPVs as small as 30,000. Could you just walk us through the fees for a manager looking to set up an SPV?
Sure. So we charge a one-time upfront fee of $2,500. It's kind of like make sure we make a little bit of money, and then we have a percentage, 1.5%. So as you have a smaller dollar amount that you raise, that 1.5% is a smaller number than if you raise a larger number, right? And then you'll need to cover the blue sky filing fees, which is a kind of a tax that the states put on top of structured vehicles. And so that's your price. So that's because of that percentage aspect or element to it, a $30,000 SPV's price is going to be smaller than if you raise $100,000, where the price is going to be a little more. We then have a standard product that once you get to a certain size, that percentage becomes prohibitive, right? Like you want to kind of turn that off. And so we have a standard product where when you hit a certain, 500K, you just roll over to a flat fee, which is flat regardless of how much you raise. You raise $100 million, it's the same price as if you raise $500,000. And so, we've got that product that allows for those smaller raises and makes it affordable.
That's great. Another question that I commonly hear that you probably are an expert on answering is there an optimal size for an SPV in your opinion, or like that you say, okay, anything around 100,000 would be great for an SPV, but you also mentioned some bigger ones. So is there an optimal size that you see, or maybe even an average size that you see?
I don't think there's an optimal size. We've had a client that raised $470 million over a weekend for an opportunity that he had found. We have individuals using our Assure Labs for $20,000 SPV. And really the optimal question has come around is like the fee, right? What's appropriate? How much of that raise is appropriate to turn around and use in a fee to like assure a third party? before it feels like too much has been pulled out and too few or too little has gone over to the portfolio company. And so as we make the pricing really affordable, we kind of feel like probably around 30,000, 35,000 starts to hit that bottom limit with Assure Labs. And there is no limit north of that. Typically, the regulators step in and cause issues before Assure's fee, like number of seats or blue sky fee. Like the regulators are messing with it more than Assure with our fee. And so average, we're seeing probably around $350,000 to $400,000 as an average. But
that's super helpful.
Yeah, but no, there's no top or bottom range that is appropriate.
You brought up a great comment. For those people who aren't familiar with the regulator limits, maybe you could outline some of the regulator limits that I believe, isn't it 99 shareholders that kind of keeps you in the blue sky laws?
Yeah, so there's two there. There's like I call it number of seats, and then there's blue sky law. So number of seats is actually more advantageous for an SPV typically than a venture fund. So a venture fund, anything over $10 million, if you're going to raise like a venture fund, your number of seats is 99. You can only have 99 LPs. And but they put a new law into place a couple of years ago that allows for, if you're basically doing early stage startup company investing and your SPV is under 10 million, then you can go up to 249 seats. And so there's a little advantageousness there for an SPV that the venture funds are not given. And so that on the number of seats, it's either 99 or 249, depending if you fall within certain rules there. Blue sky laws is basically a fee, a tax by the states. If you sell securities like LLC membership interests of an SPV to anybody of any certain state, that state will say, I want you to tell me about it and I want you to pay me a fee. And that fee's all over the place, from $0 to $1,000. And so it just depends on where those LPs that are participating come from, that then requires you to do some reporting and some fee paying.
And do you figure that out for the people who are, okay, great. I have so many good questions. Oh my God, we're going to have so much good content out of this. I'm excited. Okay. So you just brought something up about up to 249, up to $10 million. So obviously that begs the question, how much money are you seeing people put into the SPV? So could it be as little as, $10, or what's a practical amount that an investor who's forming an SPV should think about with respect to bringing LPs into the SPV itself?
Yeah, so I think it goes right back to the conversation we just had, which is blue sky fees and number of seats. So if you're going to run out of seats before you reach $250,000, right, it's simple math. What's that average? So if I take $10, I can only raise, right, not very much money, $2,500, right? And the fee of Assure is too much, and the blue sky fees are too much. So I need to go 1,000 or 2,000 or 5,000 or 10,000. So it's kind of somewhat simple math of number of seats. The other thing is that blue sky filing expense and let's say the Assure fee. The Assure fee is X dollars, and it obviously should be a very small percentage of the overall raise. But we've had individuals that have raised money from an individual from a state that has $1,000 blue sky fee, and they only put in $1,000. So 100% of their money that they put in went right back to the state where they reside, and 0 went to the startup company. So you either limit individuals from those states, or you basically say my minimum's $2,000 or $5,000 or $10,000. Other reasons to raise that number is certain individuals, organizers we work with will say, I want a certain type of investor. I want somebody that is willing or able or wants to write that large of a check.
So what's a practical minimum size that you would recommend for someone, let's say, doing a smaller SPV?
I'd say $1,000 is very typical and a great number to start off with. I've seen our clients that will start with 1,000 and then it starts to creep up, and kind of where you see some averages around $10,000, and then it creeps up. Kind of the high end is $25,000. So between $1,000 and $25,000 is basically the range, with your average around $10,000.
Oh, that's awesome. Thank you so much. And you had mentioned that the tools allow you to see the fees and the different, do you have the ability with Assure to set the limits per state, let's say, or region, so that you can intelligently manage this?
So not technologically wise, we have it like where it's really that smart. We file hundreds of these filings every month. So we know, off the top of our head, all of those things. And I would say that many times investors or organizers will just kind of put it out there, and those people that come in, they will accept it. And there could be reasons why individuals will just say, okay, I'm going to accept your money, even though a large portion of it's going to go to fees, because you're trying to build your network. That individual may introduce you to other people. And so
right.
there's a thoughtfulness around it, but just be aware that, regulators tend to impose limits and issues more so than Assure with regards to size and number of investors and fees.
I have a whole bunch of questions now coming in the chat, and I will get to them. I want to get through some of these questions that I've been asked many times, and so we have them on record. Wow, where do I begin? Let's start with, do you provide any services after the SPV is formed to help them track and manage it over time? And there's some questions related to that in the chat.
Yeah. So Assure's product is front to back, birth to death SPV services, which is, that onboarding piece, documents, bank account, EIN number, getting everybody signed, getting the money off to the startup company. And that's what I would call kind of that onboarding phase. Then there's a finalizing phase, which is, capital account statements, filing these filings like these blue sky fees to state regulators, Form Ds to the SEC, making sure all the documents get fully signed and fully executed, right? Kind of that good housekeeping. And there's post-close activities, which Assure also provides, taxes if needed, future financing rounds, corporate actions, votes, paperwork, M&A, IPO, like all of that, distributions, all that kind of long tail of post-close stuff. We're there to work closely with you with regards to, what do you want to do? How do you want to vote? What do you want to send out? And we're there to assist and provide those services alongside you.
Do you do K1s or help with K1s, I should say?
Yeah, so when we say taxes, that's the 1065 filing plus the K1s to investors. Just quick point, you don't need to do taxes every year, so we do them in the years that are required. The IRS does not require you to do them every year, only if there's a taxable event. So at Assure, we don't fill up people's inboxes with K1s that basically say zero on them. We do them when we need to and don't when we don't. But yes, we do provide the taxes.
That's awesome. All right. Some other questions. I have some interesting questions in the chat as well, but again, I want to get through some of these. What is the approach? So let's say I have a deal, it's ready to go, and I have investors, they're ready to go. What's the approximate time from everything being ready and I'm like, oh, I need an SPV, to having it ready and being able to fund?
About 5 days. And there's basically, you've got to get the entity set up, and you got to get the docs prepared, and you need to get that bank account set up. So I'd give yourself 5 business days to be able to then say, okay, now it's good to go right now for everybody to sign and wire. One final point there is don't expect to have it move that quickly if you haven't set anything up in the past. So don't come to Assure and be like, okay, what's your service and how do I do this? Like, come a week before that, or 2 weeks, or a month, or a year before that, right? And be like, okay, let me understand how this works, because you're going to need fund documents. We provide fund doc templates. You're going to need to understand the system. You're going to need like a name and stuff like that. So prepare a few weeks in advance before, and then once you have all that set up, you've done a deal, then it's really simple to be like, hey, now it turns like a flywheel, cookie cutter. It starts to become very smooth, and you can move much more quickly.
Then you're on the 5-day timeline. So let's walk through actually sort of a practical timeline that you generally experience. So you come in a week or two before, you're figuring out the system, you get ready to go, roughly a week or so to set everything up. And then what are you seeing in practical timetables? Because, having done many things like this myself, people aren't sitting there hitting refresh to wire you the money. Like, what is the practical timetable, after everything's set up and assure that you get wires from LPs, that things come in? Is that weeks, months, days?
It's typically days. And so once it's set up and you send a link out to your investor network, they basically click. They have to, if they've never experienced a Glassboard, which is Assure's online platform, they just need to fill out their profile. Very simple and easy. It's basically a 5-minute process for your investors to get set up. They just click, and they can sign. And then they receive the wire instructions. They go to their bank and send the wire. Really, 10-minute process for an investor to get through their process, and then they need to go to the bank.
Can you, if you're setting up an SPV and you're sending this out, I believe it's the 506C regulation that says you can publicly advertise it. Do you support 506C style offerings where you can publicly discuss the SPV?
Yes, so we provide that service. It's not provided in our Assure Labs, that really affordable one. But yes, we provide that service where you can do 506C offerings.
Right, and that allows you to share it on. And is there, what size limit do you recommend for 506C, given that it's not in the Assure Labs?
Probably $250,000 would be more of the bottom range of what you should raise to cover the fee.
Excellent. Okay, couple other questions, and we'll jump into questions from the chat. So you do a lot of SPVs. You're the leader in SPVs around the world. What are some of the innovative uses that you're seeing and that you would love people to know about that you can do with SPVs that you might not know?
Yeah, I think this topic is one that's very interesting, building a track record. We're seeing clients who are not accredited, and you do not need to be accredited to be an organizer. So we're seeing college students become organizers, and they're finding deal flow and setting up SPVs. Their investors are required to be accredited, but the organizer is not. We're also seeing follow-on rounds. Sidecars, venture capitalists now are really embracing SPVs for those follow-on rounds that, maybe the fund participates, but the allocation is larger than their fund can or should fill. And so we're seeing a large number of SPVs to capture follow-on pro rata allocation. That's becoming quite valuable. A number of years ago, people just let it go, just like, I don't want it, or I'll just fill a few dollars worth, and they just would let it expire. It's now becoming very, very common for them to not allow any of it to expire and to do multiple SPVs, as many as they need to fill that allocation. And and then finally is just that the LP world is really eager to participate in deal by deal SPVs. And so they're really pushing the entire industry to say, we would like to evaluate on a deal by deal basis rather than on a fund basis. And that's really where we're seeing the push in this industry is the LPs are almost demanding it.
So great point that you're seeing new fund managers use SPVs to build their track record and then take that track record to form a fund. Have you seen best practices, or do you have any best practices on how you can convert LPs in an SPV to a fund? Is it just by keeping in regular contact, or what advice do you have to that effect?
Well, what we've seen is those that are the most active convert most effectively, meaning instead of doing one deal per year, they're doing 10 deals per year. And that, keeping in contact as you're constantly out there saying, hey, I've got another deal. Are you interested? So you're constantly in front of them in a non-threatening, very casual way to say, yeah, I found another deal. This is a yes, no. It's a very simple, easy conversation rather than, would you like to commit to a longer term fund structure? And so those that are doing lots of deals also are building that track record to say, look, I have proof, right, that I can get access. And you're going to need some of that to really step out and say, I have a track record, even if it's just on paper. But I'm also hearing that, with this current environment, and these environments come and go, a lot of exits. And so, you have to be ready for those waves when exits are very popular versus, low valuations, investments are very popular. So really it's almost, it's like, building that portfolio so that you never know what's going to happen. So those that are most active in the marketplace tend to be most successful in converting to a fund.
Let's get through some of the questions in the chat now, and then I have some other great ones if we have time at the end. So Nikhil has a bunch of different questions. You've thankfully already answered some of them, but one, I don't even know the answer is good. Can crypto be accepted into an SPV? If so, any special considerations?
So crypto can. We've done hundreds of SPVs with crypto, but there's some nuances there, right? Like, is this a purchase agreement like a SAFE or convertible note or Series A stock into a company that's using crypto, or is this like a SAFT, right? Like, is this true crypto? And then there's these different levels of crypto, right? Of development. And the answer is yes. The issue that we're having at Assure and others is bank accounts being set up to pool money in order to invest in crypto assets. So the US banking system has kind of turned their back on crypto with regards to banking those types of transactions. Similar is cannabis. The banking system is less willing to bank transactions around cannabis transactions. And so the simple answer is yes, but the practical on getting it done is a little harder.
Another question from the audience. Can an SPV invest into more than one company at a time?
So yes, it can. We call those multi-asset SPVs here at Assure. Obviously, you're starting to travel that path towards a venture capital fund. And there's some kind of key differences between a simple single asset SPV and a full-fledged traditional venture fund. But yeah, you can set up an SPV with very simple SPV fund docs and a very simple process where it's not full audit, full financials, full quarterly capital calls, right? Like, so that's traditional venture capital funds. So you're over here on that simple SPV, but you're like, I just want to do 2 assets or 3 assets. The answer is absolutely yes, multi-asset SPV. Price is different. There's more work. There's more, tail. There's more, instead of 1 post-close activity or 1 follow-on, now you've got 3 because you have 3 assets in there. And so that equals more work, but absolutely you can do multiple assets into a simple SPV. We call it a multi-asset SPV.
And they're non-blind, I would take it. You know what these assets are going in.
Again, yes, right? Like there's that full spectrum of behavior and product labeling. But so what we like is, yes, it's non-blind. Like here are the three assets. Some people say, I'm going to go to a demo day and I'm going to pick 5 of them or 2 or whatever. But yeah, so you can have them blind, you can have them non-blind, but typically a multi-asset SPV is something that is going to be self-contained with regards to a time period. So like over the next few months or over this event, or, at the end of this event, I'm going to do this, or here they all are. If you know exactly what they are, many times a multi-asset or a single asset SPV per each one is better, because you're creating administration. A multi-asset SPV is creating administration. The most simple, cleanest, most affordable is a single asset SPV. And anything away from that gets more complex, more admin, more work. Sometimes it's appropriate. Sometimes it'd be better just to swing back and do something more simple, but case by case basis.
Last question from Nikhil. Can LP commitments be obtained before you set up the SPV? If so, how? One of the things we do is we use something called a PACT, a PACT. It's a commitment letter that you just say, hey, I'm committing, but I'd love to hear what techniques you've used to get commitments from LPs before the SPV is set up.
We don't participate in that per se, right? Like, so when people come to Assure, it's all about the SPV. It's all about setting the SPV, fund docs, bank account. And so you as organizers and GPs, that's a great strategy that you just spoke about. We don't have a system that helps or assists with getting commitments before the SPV. We can set them up so quickly. And basically, you don't really pay until the deal closes. So if a deal dies, we're not charged. You may have some out-of-pocket costs, but you're not being charged $5,000, $10,000. So there's really little to no risk to set up that SPV. So we just encourage people to do it early and move forward.
Right. And then if you want to know, the commitment letters could help, but then just set it up and get started, which actually, that is a great opening. Eli asked the question, what happens to the fees, the $2,500 charge when an SPV fails?
We do have some out-of-pocket costs, but we charge that when it closes. So you're not getting charged up front. So if the thing dies, then you may have a few $100s out of pocket, but you're not charged the $2,500. There's no blue skies. So you just roll forward and start your next one.
Do you have so when you say it closes, I'm presuming you set the minimum, and so if it comes under the minimum or nothing comes in, that would designate an example of not closing?
Yeah, we really work closely with our clients. Say, okay, how much are you raising? $50K. Let's say 35 comes in. Because of the variableness in the price, you can still close that transaction and do the deal. But if you said, the CEO says, if I don't bring 50, I can't bring any, whatever the reasons are, then you just say, okay, I'm going to kill this deal. Return the money, right? That's work on our part. We're gonna have to return everybody's money. We're gonna charge you a little bit of money to take care of that work, but it's not the full-fledged SPV cost. It's more like out-of-pocket cost to clean that up and then move on to the next one. So closed for us is wiring on to the portfolio company. That's closed.
Quick question related to that. Do you ever review the documents for your customers on the investment that they're making, or do you leave that entirely up to them?
So on the purchase agreement, we do review it, but we don't do some full-fledged, huge legal due diligence review. We're looking for a few things like, is the date right? Is the amount right? Is the name right? Are there any provisions in there which are kind of anti-SPV provisions? So we're doing a quick one-over, looking for kind of a rifle shot look at for a few things, but we don't do the shotgun blast of looking at every single thing in the purchase agreement. We're assuming that our clients who have the relationship, speaking to the company, doing this whole transaction, right? We're expecting you to really understand what you're getting into and what this purchase agreement's saying.
Tushar is asking, if you're a startup on the startup side, can you use an SPV to maybe bundle investors or raise capital? And I just as an aside, I know a bunch of startups that have, but I'd love to hear your answer.
Yeah, absolutely. We're seeing that startups are now becoming more aware that having a clean cap table is more advantageous than not. And so we do have startups using Assure for that. We also have a little bit of another service called Assure Syndicates, where we are out in the marketplace talking with startup companies. And if appropriate, we're doing our own SPV to help invest. But we're also doing what we call, kind of a handhold service with founders where we will help them with that SPV. They basically say, I don't want to do it. I don't want the brain, the brain damage of figuring all this out, because I'm only going to do it once, right? I'm not an organizer. I'm not going to do 10 a year. I'm building a company. I only need this SPV once or once every 3 years. And so we'll just take it on for you, right? You just send the investors to us. We'll set up the SPV. We'll onboard them. We'll get you that bundle, that pooled money check here at the end of the process. And so we either will just provide that SPV service, or we'll provide more of that hand-holding service if interested, and that's called Assure Syndicates.
Wow, I didn't know that. That's amazing. We have so many companies that could actually benefit from that. And because they might have investors that might be too small for a classic angel round or a seed round, and they don't know what to do with them. That sounds amazing. What happens to the fees? And sort of last question here, there's more now questions are coming in, of course, because they're like, whoa, what happens to the percentage carry fees and things like that if the startup is organizing around into itself, right? Do you set that at 0 or?
Yeah, you set it at 0. Yep.
Awesome. Jeremy, this was truly amazing. Actually, that last little point probably just opened up a massive amount of opportunity with the Founder Institute, because we fund tons of companies every year, and they face that very issue of having some investors that are too small, et cetera, to come in. One final question just about international. You're primarily focused on the US. Is there any exceptions that you can share or talk about?
So we're really mostly focused on Delaware LLCs. Most SPVs have a number of foreign investors. So 15-20% of all investors that we have coming through the SPVs that we do are non-US. So no issue there. We do provide a British Virgin Islands BVI service for a non-US SPV service if interested. However, typically there's really not too many good reasons to do a offshore structure. Really, a Delaware LLC is quite sufficient for most scenarios. We are seeing an uptick in individuals that are investing into non-US assets. So we say foreign, there's all these things, right? There's like the foreign jurisdiction of the SPV, there's foreign investors coming in, then there's foreign assets. We participate in all those things, but there's kind of best practices or ease of use or cost scenarios or considerations to have on each one of those foreign silos.
Awesome. Thank you so much for your time today. We'll be getting these parceled out as a overall interview as well as broken up into chunks. So you will have all the questions available as well as the presentation. We'll be putting it on fi.co. Thank you so much, Jeremy. Have a lovely morning, afternoon, or evening, wherever you're tuning in from. And this was amazing. Thank you.
Thank you.